All right, everybody, this might be one of the most level-headed videos you are going to watch on the current state of the markets, the current situation we're in. I mean, my portfolio continues to touch all-time highs every day. I've had a monumental run over the last 2 years. I definitely appreciate that, but there is also some data points that I'm definitely looking at that make me very worried about the future of the markets overall. And in this video, I am going to go over those 3 data points. I'm kind of going to go over them from what I view as the least concerning to the most concerning. So you're definitely going to want to stick around until the end of the video, because the last point I'm going to talk about is alarming, to say the least. Now, I am somebody who owns 100% stocks. I'm 100% equity. I do not plan to sell any positions over what I'm seeing. However, I think it's very important that we don't just stick our head in the sand, and instead we acknowledge that there are a lot of worrying pieces of data at this point in time, and the fact that the markets might be getting ahead of itself to a certain extent. So I'm going to go over these 3 points, and then I'm going to relay what exactly I'm doing about this at the end. I'm not selling stocks. I'm not selling any of my stocks, but I am kind of positioning myself a little bit differently at this point in time. So it's going to be an outstanding video, probably one of the more educational videos you will watch in 2025 if you haven't really been paying attention to the underlying data that is fueling a lot of this market surge. And overall, it's just going to be an outstanding video. If you want that free report down in the description on my top 4 holdings, my allocation, my thesis on these companies, my main risks, you can grab that absolutely free. It's just in the description. And as always, everybody, I appreciate the likes, the comments, the subscribes. Helps me make more videos like this. And if you do want more market videos like this versus individual stock analysis, drop it in the comments. That's kind of the only way I know you like videos like this. So let's get right into the video. And the first thing I'll preface is this video is not meant to scare anybody in terms of the current state of the markets. This is all hard data available to everybody. It's not really opinion-based or anything. It is just the data that is there right now that kind of suggests that the speculation in the case of the markets is at all-time highs. And again, I will, especially in the second point, I will point to that. We have not seen speculative activity like this very often in the last 35 plus years. And the one reason I wanted to film this video is I am getting a lot of inquiries on particular stocks that are, just to put it bluntly, terrible. Valuations, nosebleed level valuations, trading on nothing but stories. That's all there is. There's no actual results. There's forward outlook. There is nosebleed valuations relative to that forward outlook. And the more inquiries I am getting about these stocks, the more I look back to a situation like 2021, where I was getting the exact same inquiries, and a lot of these stocks absolutely collapsed and never really recovered. But I'm going to be speaking not necessarily on a lot of those stocks, but just the markets in general. So let's get into point number 1, which again is one that I view as the least concerning, but is still an indicator that we might be getting to a particular market top in terms of overall valuations, and that is the insider buying and selling ratios. So if we look to this chart here, what Guru Focus does is they focus on the amount of insider buys relative to sells. So if there is 1 insider buy to every 5 insider sells, the buy-sell ratio would come in at 0.2, and right now we sit at 0.27. Now, this is not as low as when I last looked at this ratio. When I looked at it a month ago or so to film a podcast on this, it was at about 0.2, suggesting that exact same thing, that insiders are selling stocks at 5 times the rate that they are buying stocks. Now, there's a common phrase when it comes to insider buying and selling. There's really only one reason they buy a stock, and that is the fact that they think it will go up in the future, and there is a million reasons to sell a stock. So the fact that they are selling at 5 times the rate over buying suggests to me that a lot of insiders see valuations fully priced right now, and they are exiting more holdings more than they're buying them. And again, if we come back to this chart, we can see particular instances in which insider selling has been this high. I mean, if we look to the chart right now, when we go back to 2006, This was probably one of the lowest ratios you will ever see. Insiders were selling stocks at almost 10 times the pace they were buying them. And then when the market crashed in 2008, we can see that they were buying at a absurd pace more than they were selling. However, when we look at this chart, we can see that particular instances of market highs, this ratio is relatively low. I mean, we can look back to 2021 here. The insider buy-sell ratio was at 0.17, suggesting that insiders were selling stocks at more than a 5 times pace relative to buying them. And then if we look to particular instances of bear markets, we can see that insiders generally are buying a ton of stocks, way more than they're selling. Look to 2008 when they were sky high. Look to 2015 due to that oil crash and the, just overall impact of that back in 2014, which caused some volatility in the markets. During 2019, when the markets crashed late 2018, early 2019, they went sky high. During COVID, they went sky high. During the 2022 market, they were elevated, but now we're sitting at lows. And these lows do often indicate that although stock prices are going up, insiders are not necessarily all that bullish on future price appreciation. So they are selling shares. We sit at 0.27 right now. It's definitely one of the lower rates we've seen over the last 10 years. Actually, over the last 20 years. The only times I could see it being lower were in 2021 and, 2006, 2007, when the markets were absurdly high and the market returns after this type of activity were not necessarily all that good. So this is an indicator that I don't really put a lot of extensive reliance on, but it's definitely something that, kind of piques my interest in this regard. But as we move forward to the second point, this is where it's going to get really interesting from a speculative standpoint. So the number 2 element I'm going to bring up is an indicator that Goldman Sachs publishes that is called the speculative trading indicator. And effectively what this indicator does is it tracks a lot of the most popular speculative activity in the markets, and it kind of gives an overall indicator as to how speculative the markets are right now. And I will tell you right now, this indicator, there is only 2 instances since 1990 where this indicator has been higher. And that was in 2021 when speculative mania was at all-time highs and the dot-com bubble back in 1999, 2000, around that area. So there's only 2 times, those 2 times in history where this indicator has been as high as it is right now. So the indicator primarily runs on this chart here. And what they do is analyze the dollar volume flowing into 3 particular areas that would be an indication that there's a high degree of speculation. So the first is penny stock activity. The second would be stocks with EV sales, which would be their enterprise value, which factors in market cap, debt, cash, things like that. And their sales would obviously be their revenue. When this multiple gets too high, over 10x, they would kind of indicate that would be a degree of speculation. And the third is just unprofitable stocks. So as I had mentioned, there's only 2 instances where this indicator has been higher. And if we look to this chart here, we can see that penny stocks sit at 98%. So what this is telling you is that the activity in speculative penny stocks right now is higher than 98% of the months going all the way back to 1990. So this means that out of the 420 months since 1990, we have had 9 months. That is it, of instances where penny stock activity has been higher than it is now. It is in the 98th percentile. We have, there has been not even a year over the last 35 combined that we have seen more speculative activity in penny stocks than we have right now. Now, the indicators, if we go back to the chart here, the indicators are less extreme for unprofitable and high valuation stocks, but they are still absurdly high. So there has only been 63 months in the last 420 in which unprofitable stocks have had more total dollar trading volume than they do today. Now, the other chart I want to go over, a very interesting one, same thing reported by Goldman Sachs, is options activity. So options are speculative in nature. You are buying them or you are selling them, and you are basing that buy or sell based on forward price movements. So they are speculative and in nature, and call options are bullish on the speculation side. You are buying call options anticipating that prices will accelerate and you will get stocks at cheaper than market value. So if you buy a stock with $100 strike price, you are looking for that stock to accelerate in price so that you can get it for a discount in market value. If that stock goes to $120, you'll be able to exercise that option at 100 per share and you'll profit. So they are speculative on a bullish level, and we are seeing a very high level of call options being utilized. We can see that call options now make up over 61% of options activity. So if you look at the chart, you'll see that it often makes up anywhere from 49 to 55% of activity. So generally on the 55% end, you'll be more bullish, call options more bullish. And this makes sense. The market, generally is going to be more bullish than it is bearish. We're in a bull market more often than not. However, right now at 61%, we are definitely getting in a situation where it is very high. If we look to 2021, as you can see in this chart, we peaked at 65%. And we are getting back to that point at a pretty rapid pace. I mean, even if we fast forward to the end of 2023, we were sitting at like 49%. So these call options are a bit of an indicator that the market is very, very bullish right now. And it's not necessarily bullish in buying equities. It's speculating on forward price movements because of these call options. Now, the third point, and this is probably the most alarming point out of all of this, and has been a telltale sign of excessive speculation and excessive bullishness in the markets, and it's often been correlated. Again, I don't want to scare anybody who's watching this video, but the chart I'm going to show you here is pretty damning from an indication that speculative activity has gotten out of control in terms of the markets overall. I believe this is probably due to large-scale AI bets, and a lot of people are utilizing margin to take advantage of excessive returns in the market we've seen over the last while. But the thing is, when margin debt peaks, especially when it peaks fast, there has pretty much always been a relatively rapid correction to follow. And when we look to this chart, and just a quick explanation on margin overall, it is effectively when people borrow money to invest. They leverage the assets they have in their account to borrow money from their brokerage to invest in anything, stocks, bonds, whatever it may be. And when we look to this chart, we can see that when margin debt peaks quickly, there's often a pretty big correction to follow. We look back here to 2000, we can see that margin debt accelerated very, very fast as investors became very euphoric during these times, and the market went on a 4-year drawdown. After that, margin debt collapsed, probably because of all the margin calls. The margin debt got back to a reasonable amount, and then the market started to accelerate again. We come back to the financial crisis, we can see this large uptick in margin debt. Again, the markets ended up crashing once it got too euphoric. Margin debt came back down. And then we get to a situation where margin debt, it accelerated, yes, but it was a gradual increase over the next, 2009 to 2020. And margin debt was very cheap during this time because of how low interest rates were. Now, we can see on this chart, I didn't tick these indicators off, but we can see where margin debt accelerates quite a bit. There often is a bit of a correction, but the fact is it did not accelerate all that fast. There was not very big peaks when it comes to margin debt. So we kind of have this stable situation over the next while here until we get to 2018, in which it collapsed again. The markets didn't necessarily collapse. They went through a severe correction. I remember that correction back in late 2018. It was ugly, but it was fairly quick. But when we get to 2020, 2021, we see a rapid acceleration in margin debt and then an absolute collapse. And now we fast forward to 2024 here, we're seeing a rapid acceleration again. And, if we look to past histories, this has not ended well. Whether or not it ends well this time, I'm not sure. But again, this is the data, this is the numbers. And the one interesting element here is margin debt back in 2021, 2022 would have been fairly cheap. Again, a lot of these brokerages run their margin debt off of policy rates, off of the prime rate, we would call it here in Canada. So they'll do a prime plus a certain amount. Margin debt in 2021 and 2022 was cheap. interest rates were low. We didn't really start to see that acceleration in interest rates until 2022 when margin debt got very expensive. And, this is probably what fueled a lot of this crash. But the interesting thing here is margin debt in 2024 and 2025, it is not cheap. It is very expensive to borrow on margins. Now, you could make the case that this might not occur again due to the fact that interest rates are likely going to start declining, so that margin debt will become cheaper. But again, if we look to the last 25, 27 years of the markets, whenever margin debt has got this high, it has not been a good thing for the markets overall. And I'll kind of explain why. So when you borrow on margin, your brokerage usually requires a particular amount of assets or collateral against that margin. So brokerages can vary on what type of margin they're going to issue, but let's say we're talking about a 2-to-1 ratio. So if you have $100,000 in assets, you can borrow $100,000 in margin, but you need to keep that $100,000 in assets. If it dips below this, the brokerage is going to tell you you need to deposit more money or we will margin call you. If you do not deposit more money, we will make that decision for you and sell your holdings. Now, this is an issue in any environment, but it's becoming a bit more of an issue now because there is so much U.S. household wealth tied up in equities. We're sitting at all-time highs in this regard. There has never been a point in history where U.S. households are more exposed to equities than they are now. Around 44% of U.S. households' total assets are tied up in equities, and I would bet a reasonable amount that the vast majority of these are U.S. equities as well. So when we get a situation like this where U.S. households are heavily exposed to equities, if we get into a situation where they do need to add more assets in terms of money to cover potential margin calls, they already have so much of their assets tied up in equities that they don't really have the ability to fund a potential margin call. Whereas even in earlier history, they might have had a lot more cash in some other investments that they could kind of sell to prop up that margin. We have a ton of exposure to equities, which makes it the situation where if that household is utilizing margin, they will not have the assets to cover that margin because maybe the other portion of those assets are tied up in their home, which is not exactly a liquid asset, or their vehicle, which is not exactly a liquid asset. So they really don't have any money to cover that margin. So effectively, they will be forced to sell those shares. And in a situation where there is extensive margin, there is a feedback loop created when margin gets called away, when there is margin calls. So we can have a situation where downward pressure is put on stocks to the point where a person has margin utilized, they cannot cover that margin, so they have to sell that stock, which again continues to put downward pressure on the price of the stock, which in turn can cause margin calls elsewhere to people that would have been covered on the initial drop but are not covered now. And it creates a bit of a feedback loop where margin creates consistent downward pressure on stocks. And if we look to an index level, if people are margined on an index level, this can impact every single stock on the market. It does not matter whether you own the best company in the world. Extensive margin leading to margin calls and continued downward pressure on stocks can lead to an accelerated sell-off. It could be a perfectly normal market correction, which we have to accept that we're going to go through. But when the previous bull market is fueled primarily through margin, it can take a relatively simple correction that might have been 10 or 15% and amplify it to be much worse than that. This can even happen in an environment where investors are still relatively bullish because they may not want to sell stocks, but they might be forced to sell stocks because they've leveraged themselves up and ultimately they have to pay the price because they don't have the assets to cover that margin. And the other addition here is in the case of heightened market volatility, your broker can modify your margin agreement and lower it, meaning they might decide tomorrow that you need more assets to cover that margin that you've created. So you're either going to have to reduce your margin, which would likely result in you selling stocks to cover that margin base, or you're going to have to come up with more assets because the markets are volatile enough that your brokerage does not believe that, in the worst case situation, you might not be able to cover that margin. And again, if we look through the gradual increase post-financial crisis of margin debt, it's not really all that alarming. But if we look to the case of 2000, 2007, we look to the case of 2018, we look to the case of 2021, often large amounts of margin debt have been heavily correlated with relatively strong corrections in the future. So we've got all these signals, and I know people are going to be wondering what exactly I am doing. Now, I run a platform. I provide research to thousands of people on stocks that I potentially feel have opportunity. And I have really, really struggled to identify any stocks at this point in time with a reasonable margin of safety, especially in the US markets. I'm finding a reasonable amount of opportunities in Canada, especially Canadian businesses that operate in the United States, not necessarily Canadian pure plays. They tend to have lower valuations, so I do tend to see a little bit more value there, but I am struggling to find value in the US markets. And a lot of people might think I'm crazy in this regard because they're buying US stocks hand over fist and they're continuing to go up. But the difficulty is the market will almost always revert back to fundamentals. Valuation can go to a point where it does not matter for 2 years, for 5 years, for 7 years. But eventually the market will revert back to the mean. And historically, it has provided 8 to 10% returns annually over the last century. That is a monumental amount of data to kind of indicate that those are generally the average returns you're going to get from the market. So when you go on the run, that I have personally, and a lot of investors have, 30% years. Once you've been through a lot of these situations, you can always kind of come to the conclusion that, again, it will revert back to the mean. Now, in the best case scenario, that would be maybe we see some flat market conditions for 2, 3, 4, 5 years. Obviously, in the worst case scenario, we have a market crash. And the difficulty here is predicting when it can happen. Now, I've relayed all this data, but the fact is, the markets they do say the markets can remain irrational longer than you can remain solvent, which is why I would never do anything crazy like short a market like this or go full doomsday and sell my holdings and, go into cash, go into physical assets like gold, like, treasury bills, things like that. This is why I remain 100% invested. But I also do acknowledge the fact that this environment is not sustainable over the long term. For a lot of investors, what this means is you need to be positioning yourself for long-term returns. This is what I do every single time I buy a stock. It is very easy to go on a platform like X, a platform like Blossom, Facebook, and see these people who are up 30, 40, 50% a year, which, again, outstanding returns, but there is extensive risk being placed in these returns. And I find a lot of investors will get caught up in their year-to-date returns because of the monumental run in the market, and they'll start trying to structure their portfolio to maximize returns over the course of 3 months, 6 months, a year, when in reality, what you need to be doing is positioning your portfolio to benefit from the best long-term returns. Because again, 20 to 30 to 40% returns on the market is unsustainable. History has showed us over the last 100 years that there will always be a reversion to the mean, whether that be through flat market returns or whether that be through a crash. You will not see these returns in your portfolio long-term. It just has not happened. Now, can it continue to happen for the next 2, 3, 4, 5 years? Absolutely it can, which is why you do need to stay invested. But you also need to acknowledge the fact that this data does exist and you need to stop chasing returns. And I say that because I am getting a ton of inquiries from highly, highly speculative stocks that are trading at valuations that it's a house of cards. They are unsustainable. You might make money over the next 6 months. You might make money over the next year, 2 years. But eventually there will be a reversion back to what is normal. I saw so many investors get caught up in this type of situation back in 2021. And it seems crazy to say this because the markets have gone on a monumental run over the last while, but some of them have still not recovered from betting too heavy on speculative plays back in 2021. So everybody, that's it for the video. Probably ran on quite a bit here, but it's really hard to explain this in a quick video. I really hope you like these data points. I hope, it doesn't necessarily, this video was not meant to scare anybody. And again, I'm filming this, I'm explaining all these key data points that kind of point towards extensive speculation in the markets, but I'm staying 100% invested because, I mean, I know every company that I own. I know they are long-term winners. I know I have paid fair prices for them. And it's just, you know, I acknowledge the fact that although all this data exists, the markets can go on a massive run over the next 2-3 years. We might, you know, you never know when this story is going to end, but, you know, history has shown us that it will end. It just depends on when. So for that reason, I stay invested at all times. So if you like the video, head down below, comment, let me know what you think, like, subscribe. If you want more videos like this, I'm happy to provide them. You just got to let me know because I base most of the future videos from the comments and the feedback I receive from thousands of investors. And as always, stay tuned for more great investing content.